Topic examines illiquid markets, market imperfections, behavioral biases, and the concept of unsmoothing in financial analysis. Illiquid markets are characterized by limited trading activity, wide bid-ask spreads, low market depth, and significant transaction costs. Assets such as private equity, real estate, infrastructure investments, and certain structured products often trade infrequently, making valuation and price discovery more difficult. The topic emphasizes that illiquidity affects both investment returns and risk measurement because assets cannot always be sold quickly without substantial price concessions. Market imperfections such as information asymmetry, transaction costs, regulatory constraints, and limited market participation further reduce efficiency and contribute to pricing distortions within illiquid financial markets. A major focus of the topic is the impact of market imperfections and behavioral biases on asset valuation and investment decisions. In illiquid markets, investors may rely heavily on appraisals, estimates, or infrequent transactions to determine asset values. This can create valuation inaccuracies and delayed recognition of market conditions. Behavioral biases such as overconfidence, anchoring, herding, and optimism may further distort investment decisions because limited market transparency reduces objective price signals. The topic explains that investors often underestimate liquidity risk during stable economic periods and overreact during stressed conditions. Consequently, illiquid asset markets may experience amplified volatility and valuation adjustments when market sentiment changes or financial stress intensifies. The topic also discusses return smoothing and the process of unsmoothing asset returns. Illiquid assets frequently exhibit artificially stable return patterns because valuations are based on periodic appraisals rather than continuous market pricing. This smoothing effect understates actual volatility and correlations with broader financial markets, potentially misleading investors regarding portfolio risk. Unsmoothing techniques adjust reported returns to estimate the underlying economic volatility and more accurately reflect market exposures. The topic highlights that failure to unsmooth returns may result in underestimated risk measures, inaccurate diversification assumptions, and flawed portfolio optimization decisions. Proper risk analysis therefore requires understanding how illiquidity affects reported performance and statistical measurements. Topic also focuses on illiquidity risk premiums and portfolio allocation decisions involving illiquid assets. Illiquidity risk premiums represent the additional expected returns investors demand for holding assets that cannot be traded easily or quickly. Investors accepting reduced flexibility and higher transaction costs generally expect compensation through enhanced long-term returns. Illiquid assets such as private equity, venture capital, hedge funds, real estate, and infrastructure investments may therefore offer return premiums compared to highly liquid public securities. The topic explains that these premiums arise because investors bear additional uncertainty regarding valuation, exit timing, market access, and funding conditions during stressed financial environments. A key concept discussed in the topic is the role of illiquid assets in portfolio diversification and strategic asset allocation. Illiquid investments may provide diversification benefits because their returns are influenced by different economic drivers than traditional publicly traded assets. Long-term institutional investors such as pension funds, endowments, and sovereign wealth funds often allocate portions of their portfolios to illiquid assets to enhance returns and reduce reliance on public market performance. However, the topic emphasizes that illiquid investments also introduce significant liquidity constraints, valuation uncertainty, and operational complexity. Portfolio managers must therefore evaluate investment horizons, cash flow needs, and risk tolerance carefully before committing capital to illiquid asset classes. The topic concludes by emphasizing the importance of balancing return enhancement opportunities against liquidity risks within portfolio management frameworks. Illiquid assets may improve long-term returns and diversification outcomes, but excessive exposure can create funding difficulties during market stress when investors need liquidity quickly. Effective portfolio allocation requires stress testing, scenario analysis, and careful assessment of liquidity needs under varying economic conditions. Institutions must also consider governance structures, valuation methodologies, and regulatory requirements associated with illiquid investments. The topic highlights that understanding illiquidity risk premiums, market imperfections, and behavioral biases is essential for constructing resilient portfolios capable of achieving long-term investment objectives while maintaining adequate liquidity and financial flexibility.